Okay, we're going to get started today by looking at the S&P 500. And we can see we are in a downtrend. We're making lower highs and lower lows. What I did was I mapped out in the green line a trajectory of what probably is going to happen. Um, you can see that we've been having these mini rallies like last Monday where we went up just a little bit to get people sucked in, and then we're going back down. So we're in a phase right now um, where we have lost momentum. We've lost all of the moving averages, and the trend now is down. So that means we can basically let's look at the stochastics for each of the sectors that we're following. You can see that the QQQ is in a downtrend and it's oversold. That doesn't mean it can't be more oversold. You can see this is the aerospace and defense ETF. It is in an uptrend and it's oversold, but you can see that it's at the bottom end of its upward trajectory channel. So the defense sector, of course, has a war that's helping it. So although we've been down for quite a while, this is the bottom end of the channel. So we're not following any of the defense stocks. So a lot of times whenever you get to this spot where it's in an uptrend and it's time to buy, um, you got to be ready with a stock that's in that sector, but we're not ready right now. You can see that gold is actually oversold, but right now it's holding up at its 150-day moving average, the GLD. Usually in times of turmoil, um, people gravitate towards gold. And whenever there's a war, whenever there's high inflation, um, a lot of times gold is a hedge against inflation. So we'll keep our eye on gold. You can see discretionary, consumer discretionary sector is going down. Just think, whenever people are losing their jobs, people are not going to be spending on discretionary items. And as the war progresses, um, people will be more and more selective with what they buy. You can see this is the materials sector, and it's been in an uptrend, you can see. And it's doing pretty good, actually. And let's look at the next sector. The communication sector, services sector. This is mostly high Facebook, Google, a lot of the big tech stocks that they've lumped into this communication sector, and all of the Mag 7 stocks aren't doing good. So as with the market and with QQQ, as goes the XLC. Um, the healthcare sector is surprisingly not doing good. You would think in a time when people need dividends and stability, they would reach towards healthcare, but right now it's out of favor with the market. Um, let's look at the XLP, which is the Consumer Staples Select Sector ETF. It is in an uptrend, and you can see it's oversold, but this is a great time to start looking at these kind of stocks. Um, Hold on for a second. I'm going to do a search. It'll be worth it. Okay, so we just did a Google search. The XLP top holdings: Walmart, Costco, Procter and Gamble, Coca-Cola, Philip Morris, Colgate-Palmolive, PepsiCo, Altria, Mondelez, and Monster Beverage. Okay, so these are the kind of stocks um, that will do good in an environment that's where you need a high dividend paying stock that's stable, stable demand in good times and bad, And this is the kind of stock um, that pays a dividend, and it's a safe sector in a downward trending market. Okay, so that's a good exercise. Let's look at financial sector is down a lot. There's a possible crisis in um, in the credit market right now, and all the financials are going down with that fear. So let's look at the XLU. Oh, look at that. This is in an uptrend. And this is the utility sector. You can see that it's at the bottom end of its trading range. And if you're looking to buy some utilities, this could be a good time to buy that. It pays a dividend, and it has the kicker of being an AI related beneficiary because they provide electric for the AI data centers. Let's look at this one. This one is real estate sector. You can see as the interest rates have been going higher, let's look at the interest rates. The 10-year interest rates comparison to the S&P 500. You can see that the 10-year Treasury rate is skyrocketing, and it's an inverse correlation to the S&P 500. So as with basically the formula, it's pretty simple. The oil price of oil is going up. That's a pretty big part of inflation. As the price of oil goes up, as the war continues and gets worse, um, the fears of inflation go up, and with that, the Fed is most likely going to be raising rates more than reducing rates. So that's making the yield go up. And as the yield goes up, the profitability of the stock market goes down. That's why the stock market's going down as an inverse correlation. Now, keeping that in mind, let's look at the State Street real estate ETF. As the yields are going higher in the 10-year, the mortgage rates will be going higher, and the profitability of the housing companies goes lower because people can't afford the mortgages as well as with lower interest rates. So let's look at the energy, XLE. This is a super powered sector right now. As the war continues and gets worse, this sector will continue to do better. But whenever there is some kind of resolution, this sector will drop like a rock. So you have to keep that in mind. Um, let's look at the home construction ETF. You can see that it dropped as an inverse correlation to the price of the yield of the 10-year. As this yield of the 10-year goes higher, the profitability and the viability of these home companies goes lower. So, okay, that was a good exercise. Let's go back to our talking points. Okay, so I have this whole month of March as yellow, meaning it's a pretty dangerous time for investing. We're in a downtrend, and um, we have to assume that prices will be going lower and in the stock market in the intermediate and time in the stock market. So that's why I have yellow. Um, we're starting April, and you can see that we have this as yellow also. We have the Fed meeting towards the end of the month. Um, we have an options expiration day on the 17th of April, and mm, that's about it. All right, so there's not a whole lot going on for earnings reports either right now. So let's look at some of the earnings reports coming out this week. There's no big companies that came out this week with earnings. So it was kind of a no news week for earnings. Next week, we'll have Nike on Tuesday. That's the biggest company that could move the market a little bit. Um, so basically, earnings season's over. The banks are going to report next. at the start of the earnings season for the next quarter. So we don't have earnings right now in to help the stocks or hurt the stocks. So we have to rely on news from the war and tweets from the president to let us know where the market's going next. Okay, let's look at okay, hold on for 1 second. Okay. So S&P 500 is down 2% from last week. And we have a loss of momentum. We have the 10-year treasuries up, and we have a loss of momentum. We have people selling. We have people fearful and extreme fear in the market, and we have the oscillator from the S&P short range oscillators oversold right now. Now, we are from the beginning of the year, we've been saying that we have the possible revert to the mean um, that could happen. The stocks that were out of favor, such as healthcare, telecom, financials, energy, utilities, biotech, they did worse last year, and there could be a reversion to the mean. Also, S&P 500 PE is 24 now, and the long-term average is around 15 to 17. So we could go down in the stock market to return to the mean, to the average. Okay, let's look at seasonality wise, we're going into one of the best months, the actual best month of the year. However, the stock market uncertainty with the war and the price of oil and the Strait of Hormuz is trumping any market timing or seasonality that we've relied on in the past. This stuff only works whenever you're in an uptrend and things are going good. Otherwise, the prevailing trend right now is down. Okay, so we already talked about the S&P chart. It's definitely in a downtrend. We have an oversold condition. That doesn't mean it can't get more oversold. So you see, okay, so here's basically what's happening in the stock market. Um, the price of oil is basically dictating a lot of what's going on right now. As the oil price increases, inflation increases. And when inflation increases, the chance of rate cuts from the Fed go down, and the chances of rate hikes from the Fed go up. When the Fed hikes rates, the stock markets don't like it, and they most likely go down or don't go up. Um, Whenever inflation increases, there's a very good chance that a recession is going to happen. So the chances of a recession is going up as the 10-year yield goes up and as inflation increases. So stock markets go down during recessions. This is basically what's happening right now. We're currently in a downtrend. And right now, it's not a good idea to catch a falling knife, especially for high growth names that have done well in the past couple of years and have a high PE, high PEG ratio. Um, you want to like not take the risk of buying big chunks of stocks right now because we're in a downtrend. Um, but you don't want to time the market and try to try to sell and time the bottom. Right now, this is a very good chart to watch. Right now, we have two different. These are basically moving averages. The red lines are the short-term moving averages, and the blue lines are the long-term moving averages. And you can see that right around here at the end of February, we switched from an uptrend to a downtrend. And whenever we're in a prevailing downtrend, it's not a good idea to um, to make big bets on stocks going up. And you have to, um, let's look at how this chart looked back last year at this time when um, we had the time when Trump was increasing the tariffs on all the countries. So we had basically this red line is the long short-term moving averages, and it started going up like right here, and the long-term moving averages started going up probably right here. So this is basically whenever we have this trend stop from a downtrend to an uptrend, like right here. And the reason why we're going over this, it's because if you're putting money into the stock market, um, you want to try to put if you're a growth investor and you start seeing stocks on sale, you don't know when we're going to hit this moment of stocks wiping out. So if you're interested in stocks and they're getting interesting, you buy just a baby's amount at a time, um, if anything. But in general, waiting for this turning point is probably a better time to start looking at buying things if you're a long-term investor. Also, it's good to keep in mind that it's if you already have a portfolio of stocks that um, that it's not a good idea to try to sell out of stocks and buy stocks at the low because it's really hard to time these kind of things. And I'll give you a little chart little later about the if you miss this one day right here, if you miss the best 5 days of the market, then you lose like half your returns. So I'll go over those numbers a little bit later. But right now, thing to keep in mind is we're in a downtrend and the momentum is down. So you have to assume every day that the prices are going to be lower. So if you buy stocks, then you buy just little tiny bits and assume that you get better prices in the coming days. Um, but in general, I guess the best thing to do is to wait for us to have like positive momentum. A lot of this has to do with the war and the Strait of Hormuz right now. And inflation is a direct um, result. High inflation is a direct result of all that. So if we do get some kind of resolution, we're going to get like a 5% up day, and you don't want to miss that. So that's why it's pretty important to have a diversified portfolio and be invested through good times and bad. Um, it's really, I'll keep updating this chart. It's really good to keep this chart in mind. And whenever we do start that turn, that could be a time to start dollar costing into some of the growth part of your portfolio. All right, so let's look at the 10-year. The 10-year, we already saw this. You can see that it's going up a lot. And that's like almost a one-to-one correlation to inflation expectations recently. So any stock that counts on borrowing money is going to take a hit. And when any stock that's yielding, a high yielding stock is going to be in less demand. Let's look at the price of crude uh, oil is up 4% from last week. So as the Strait of Hormuz, this is a crisis. This Strait of Hormuz being closed is the worst disruption of oil in history. That is, we have so many things right now leading to disruption in the stock market um, that you have to realize this is a major event. It's not just not like a minor correction. It's a major event. Um, and if this continues to be closed, we're going to have higher oil prices and higher inflation, and that is bad for the stock market. The dollar index is up 1%. So this dollar is getting stronger through this. And gold is going, it went down 2% last week. So there's an inverse correlation with the dollar and gold. As the dollar index increases, um, price of commodities in general go down because most commodities are priced in dollars. So there is a correlation this week. Um, you can see the dollar index has been going up, and that that correlates like almost 1 to 1 to the price of gold in the past month or so. Okay, so let's look at the fear and greed index. The fear and greed index is extreme fear, much more fear than last week. So, so right now we know we're in a downtrend, so we're not going to be like holding our nose and buying, but we're keeping our eyes open for quality companies that are on sale. And if you're not invested at all, this is a good time to look at peg ratios and see if you get any bargains. And I like to look at ETFs and I like to look at net asset values. A lot of times in sell-offs, the net asset value of ETFs um, are lower than where they're trading at. So you get like um, you get your stocks on sale that way. We'll do that next week. Look into that. You can see right now the AAII survey, people are bearish. So um, right now, the translation is to start looking for something to buy. The VIX is now at 24. It went up as high as 30. So I think right now people are fearful. We're starting a extreme fear, and there's a little bit of panic in the market. Um, we're not up to 50 yet, but whenever we see a panic and a crash, that's a good indication that we are at a point where we could just turn around and start going up. So in our emotional graph, you can see we're near capitulation between fear and capitulation. We have so many things that are unknown, and the stock market hates unknown. That issues we've been keeping track of issues that may lead to a crash. We have um, stocks that are overvalued. All the Mag 7 stocks are trading towards their fair value. We have consumer debt and private credit issues. We have the U.S. economy faced with very high oil prices, which could lead to a recession. And yet another thing, we have, of course, the tariffs that are in the background right now. We have the war with Iran causing the Strait of Hormuz to be closed. So all these things are ingredients to people capitulating in a crash situation. So you got to be ready for that. All right. So, okay. So we're still at a very high PE ratio, around 23 according to Wall Street Journal, compared to history. And the PE of the S&P is usually at 16. It's a 10-year, 20-year average. So we can easily go down 20% to be down to the average, the PE ratio. Um, one thing to keep in mind is Morningstar actually thinks that we are undervalued in the stock market. Morningstar thinks the S&P 500 is undervalued by 17%. So that's because the earnings of the S&P are doing pretty good. All right, so let's look at our first to worst, and this has actually turned out to be perfect. Correlate um, the best stocks from last year are becoming the worst from this year. We have the communication services QQQ down 2 and 5% so far this year. Financials down 10%, and energy up 30%. Last year it was only up 4%. So consumer staples is only up 10%, but I would think people would gravitate towards that sector in really scary times like right now. So I guess we're Um, if you're not invested in consumer staples, it's time to start looking um, at conservative stocks like that. All right, so PE valuations compared to history, financials are the worst um, in evaluation, meaning they're most undervalued. You have healthcare and real estate, utilities, material, energy, and consumer discretionary is the highest valuation compared to history. So that's why an environment when people are being fired from AI, when there's a war, when the price of gas is going up, people don't spend as much and they're going to cut back on unnecessary expenses, which is consumer discretionary index. So that's a pretty scary thing to be invested in right now. So let's look at, let me see, look at, let's look at some of the stocks going up and down today. Well, first of all, let's look at this 10-year. You can see the rates are going up. So let's look at our cheat sheet from the years, the yields of the 10-year going up. It's negative for any stock that needs to borrow money. Tech stocks, growth stocks, highly sensitive to borrowing money. Small cap stocks, heavily indebted stocks. Um, Also, high yielding stocks are going to not be as in demand because if the price of the 10-year, the guaranteed investment goes up, there's a less demand for high yielding stocks. Home builders are going to take a hit and REITs. The stocks doing positive for 10 years going up are energy, materials, insurers, insurance companies, banks, and large cap tech. Let's look at what's happening in the stocks going up and down. So if we look at the sectors that are doing the best today, okay, biotech is doing the worst. So we know biotechs are heavily indebted. They need to borrow money to fund their operations because they're developing their new treatments and there's not a whole lot of money coming in. So that makes sense. Um, Consumer discretionary, that makes sense because people aren't going to go out and buy a new car whenever the people around them are losing their jobs and the price of oil is high. Things that aren't necessary are the last in a thing to buy in a stressful environment. Um, Financials are down. You have banks that are down. We have technology. Um, right now, we have a risk off environment, meaning people are gravitating towards safe investments when the stock market is crashing and going down. So these are all basically risk on investments right now. The stocks going up the most, we have gold, gold miners, State Street Energy, we have energy, we have S&P oil. Okay, so these are all conservative sectors that pay dividends and that are safe in, let's look at, hold on, okay, our war with Iraq game plan we made as soon as one day after the war started. Um, we outlined what risk on and risk off was. The sectors that will do good and bad in this kind of environment. When you have a risk off, like we have right now, gold and silver usually do better because they're a hedge against global uncertainty and inflation. You have materials, um, energy, consumer staples, utilities, and healthcare. Healthcare is actually not doing good in this environment for some reason. Usually that is a defensive sector. Defense companies should be doing good, but we saw with the stochastics, they have been down with everything else. So that defensive stocks could be a good sector to look into now. Um, Risk off, that's risk off. Risk on, the communication sector, IT, financials, industrials, consumer discretionary. You can see that all of these are in the top stocks going down. So this is right on with what's going on. And this probably will continue as long as we are in that downtrend. All right, that's a good exercise. Okay, let's look at some of the stocks going up and down today. Okay, so all of these are conservative stocks. They pay dividends. They are in energy, all the sectors that we mentioned um, that are safe sectors, risk off. And the ones doing the worst are the risk on AI infrastructure companies. Datadog has a very high PE ratio. Um, this is interesting. Right now, we have all the software companies going down together because of a risk of AI um, hurting their business. But I saw an article on Morningstar. It's 27 companies with wide moats that won't be snuffed out by AI. And look at one of the stocks that were on that list. We have Datadog. So Datadog is basically a company, they're very risky. They do um, they're like a software for the cloud. So they do a lot of analyzing of logs and give you reports and things like that. So there's a fear that a lot of the software companies are going to be disrupted with AI. So it's times like this when sometimes babies get thrown out with the bathwater, and that's why you got to look at lists. This is a article where Morningstar went. They keep track of companies' moats. That means, well, moats are a term that Warren Buffett came up with that basically says how much of an advantage that companies have over other companies due to a maybe a patent or um, impenetrable market dominance. And let's look at some of these companies that have wide moats that won't be snuffed out by AI. You can see that, first of all, these companies, a lot of companies in have been sold off in the software sector recently, and with the fear of being disrupted. Um, some of them are down 30%. And look at this, Microsoft is down 29%. Zscaler, they're at cybersecurity, down 32%. Salesforce, down 26%. Thomson Reuters, down 28%. Broadridge, um, the, Thomson Reuters and Broadridge are more financial related. Um, so let's look at some of the ones that Morningstar says has a wide moat. Look at that. They all have wide moats. Autodesk, they make 3D drafting software. Booking Holdings. Um, I could see Booking Holdings though. They make Priceline and a lot of the online booking for trips. I could see asking Google, book me a trip to um, China at the least expensive for this date. And that would totally take Booking Holdings out of the equation. So there's a very good chance that Booking Holdings, though, would be disrupted with AI. Um, CrowdStrike is the number one provider of cybersecurity in the world. Whenever you have a number one of anything on sale, it's a good chance to it's a good idea to start looking at it. But CrowdStrike's PE ratio is sky high, and it's not a bargain, so I wouldn't buy it. But it's an example of a stock that is number one in their industry, and if they came down enough, it would be a good stock to look at. You have ICE, Intercontinental Exchange. They have um, they have one of the best IPO systems in the world, and they have more IPOs than any other company. So they have the CNBC on set giving them free advertising every day. So they have a good um, setup there. But there is more competition coming with new exchanges coming out every day. So I don't know how much of a moat they have though. We'll see. Microsoft. We talked about Microsoft last week. Moody's is um, one of the stocks that Berkshire Hathaway said they would never sell. So Moody's is down with the other financial related stocks, but they might have a moat that allows them to compete 20 years from now. So these are all stocks that are good to look at as we have sell-offs like we have now. Um, okay, let's go back to our top 10. Okay, you can see Datadog is one of the stocks going down a lot today. We have Coinbase, we have Airbnb. These are all high PE ratio stocks. Okay, so almost every one of them has a PEG ratio over 2, and it's closer to 3 or 4. And one of the things I said in my cheat sheet here, where is it? There it is right here. Um, okay, you want to have look for stocks with lower PEG ratio and higher dividends in an environment like this. So, okay, so that was a good excursion. I picked out some stock charts that are interesting. This stock right here it's a stock of GLD. It's the ETF for gold. And you can see that it's holding at its 150-day moving average. It went down at least 10% in the past um, month or so. It's very surprising. Usually, whenever there's a war and uncertainty in the world, the silver and gold do well. It could have been that a lot of central banks were repositioning, and there's a lot of momentum traders in the stock market. This is one of the biggest momentum trades for the past 2 years. So as momentum trades unwind, you have possible selling off of stocks for on margin and stuff like that, and there's a forced selling. But this is it's basically holding at this 150-day moving average. This is the 200-day moving average. It seems like a good stock to hold, or it's a good thing to hold in a time of war and time of uncertainty. So we'll keep our eyes on gold and see if it actually continues an uptrend or continues this downtrend. All right. Um, Warren Buffett, by the way, would never buy gold because it doesn't produce anything, and he thinks it's basically speculation because Warren Buffett likes stocks that are generating earnings and paying dividends. So let's look at the next one here. State Street Consumer Discretionary. You can see that it's in a downtrend as people get afraid about their jobs and as there is a war and the prices of things are going up in inflation, people are not going to spend on discretionary items, things that they don't need necessarily. So that's why this sector is going down. But this one right here is consumer staples selector sector. And you can see that it's at the bottom end of the range. It is the perfect time to start looking for stocks in this sector. A lot of them are undervalued and they've been out of favor for quite a while. Um, you can see that we've had this like time where we're not going anywhere for like multiple years. We're in a sideways pattern, and we're right still in that sideways pattern, but we're starting an uptrend. So if you don't own any consumer staple stocks, this could be a good time because people gravitate towards safe stocks like consumer staples in a unstable environment like a war situation. You can see that XLU is in an uptrend. We mentioned that earlier. Um, let's look at Google. Google is it was in an uptrend for quite a while. It broke its uptrend and it started a downtrend with the S&P 500. It's almost ex identical to the S&P. You can see we're right at the 200-day moving average right now, but and we're oversold. But you can see that um, as the S&P 500 goes, so does Google. So we're going to follow um, our chart to see where the trend is in the stock market to see if it's a good idea to start buying or selling Google. Okay, let's look at Philip Morris. This is Philip Morris. This is Altria. Altria is a stock that pays a dividend. You can see that it is above all its moving averages. So this is an example of a defensive stock. It pays a dividend of like 6%. And people are going to smoke just as much in good times and it's bad. Actually, there are some people that say that in bad times, people smoke more because they're depressed. So it's a good stock. I've owned this for the long. This is one of the oldest stocks in my portfolio, and I'm in general, if you go back 50 years, this is one of the best returning stocks of all time because it spins off sometimes some companies. It pays a high dividend, and um, it's just a good high yielding stock for the high yielding part of your portfolio. Um, look at CSX. This is an example of a domestic company. They're not affected a whole lot by what's going on overseas. They have contracts where they can increase their costs based on the price of energy. So I think this stock is very similar to Verizon and some of the utilities in that there's a steady demand in good times and bad. Um, if there is a recession, there will be a lack of demand for some rail cars, but it's U.S. based and it's insulated from the war right now. Um, I've owned CSX since like 2010, so I'm never going to sell this. They have a monopoly. There's only one or two there's one, two, or three railroads in America, and they're not building new railroads. So they have pricing power too. Um, okay, PepsiCo. This is an example of a consumer staple. You can see that it's down at the bottom of its trading range and it's oversold. And as I mentioned, the consumer staples sector has sold off. So I think this is a good stock to I've held this since 2010 also. So this is an example of a stock that's grows 3% a year, but it pays 3.5% yield. So it's a stock for the dividend part of your portfolio. And look at this, Procter and Gamble. It's also down. It's started this little uptrend here, and you can see that it's at the bottom end of its range, and it pays a pretty high dividend. And it's an example of a stock that does good in a crazy environment like we're in now. Waste management. We talked about this last week. You can see that it also is at the bottom end of its trading range and it's in an uptrend. Um, it's an example of a stock, regardless of what's going on with the war or anything else, it'll still have a moat. They have a duopoly in America with Republic Services, so they can raise their rates over time. They make money from recycling They also have energy business where they're making energy from methane from their garbage dump yields. So um, it's an example of a stock that's conservative, that pays a dividend, and they'll continue to grow like 10% a year over time. Um, okay, Walmart. It's an example of a very conservative stock that pays a dividend, that's steady demand in a good times and bad times. And they're a little bit pricey right now. I looked at the charts of the finan. This is an example of a financial. Um, Both MasterCard and Visa are in downtrends. And you can see that until we have an uptrend, we're going to have almost every one of these charts in the financials following the S&P 500. We have an interesting situation here with MasterCard. You can see that there's a lot of support where we're at right now. You can see back in April of last year, we went down to this exact spot. And this April of 2024, we had it maxed out at this same spot. So there's a lot of support where we're at right now in MasterCard. MasterCard's growing at like 15% a year. And in a recession, they're like a toll collector. So they take a portion of every transaction. If there's a recession, there aren't as many transactions with not as much volume. So that is the scare right now, that we're going into a recession and most banks don't do well in recessions. Um, let's look at eBay. You can see that it is in an uptrend. Just think of what's happening right now. If we go into some kind of recession or um, time when people are scared, and they're going to go to eBay and try to buy things used instead of buying them new. That's why eBay would be almost the opposite of consumer discretionary sector, because people people tend to buy things used whenever times are bad. Okay, let's look at a couple ideas here. Walter Deemer has a saying, when the time comes to buy, you won't want to. And the stock market will do whatever it has to do to embarrass the greatest number of people and to the greatest extent possible. So he just wrote a message. That's his book. He just wrote a message. The important thing is that the market isn't that the market is oversold. It's how the market responds to its oversold condition. So basically, let's look at another words of wisdom from Dougie Cass. He said, there's a lot of people on the news and the CNBC that are like super optimistic, and they're saying, "Oh, this AI is going to go on forever." And um, this guy is actually saying a contrary view and basically pointing out things. There are economic risks right now. The threat to global economic growth is obvious. There's geopolitical risk. There is interest rate and inflation risk. Um, Interest rates are rising in unison. And there's a credit risk. This is really important. Credit spreads are widening in dramatic fashion. And there is corporate profit risk. Demand is moderating and input costs are rising. So we have inflation causing input costs to rise, and we have consumers spending less. And that could lead, there is a valuation risk. The S&P multiples have dropped from 22 to 20. So okay, so basically, he's basically saying that there is there's storms brewing, and there's things that are actually happening that could cause the stock market to go down. And you got to keep in mind these things. Um, Here's another thing, this side of the story. Larry Fink says, um, he says warns against market timing. He says the missing the best days can have returns. He basically said, over time, staying invested has mattered far more than getting the timing right. Fink wrote that his annual chairman's letter. He warned that the rapid rise of AI could amplify inequality. And okay, so his idea is you got to stay invested. It's time in the market, not timing the market. So keep that in mind. It's good to have an idea of where we are in our trend because you got to have a mental readiness for the stock market to go down every day. Um, Missing the best days in the stock market drastically reduces long-term returns. Um, Impact of missing the top market days 30-year data. Fully invested, highly consistent returns. Missing the best 10 days, returns are roughly cut in half. Can you believe that? Missing the 30 best days, returns are reduced by over 80%. Performance missing only 10 to 20 days over 20 years can cause a portfolio to underperform compared to simply holding. So, takeaways are the best days are clustered with the worst days. A large percentage of the market's best days occur shortly after the worst. Um, Stay invested in time in the market usually beats trying to pick the right days. And risk of selling, missing just two top days, can make a difference between a high performing portfolio and one that barely breaks even. So, um, here's something that Dougie Cass mentioned. He said consumer staples and defensive sectors provide value in today's overvalued market. So he's saying the same thing that I'm saying here, that consumer staples compared to the S&P right now are um, they're on sale compared to the S&P. So they haven't gotten any love. This is a great time to start looking at some of the defensive consumer staples. Um, Here's a cartoon I saw. And while there's no reason yet to panic, I think it's only prudent that we make preparations to panic. Um, okay, so I thought it'd be interesting. Let me see. Okay, I thought it'd be interesting to review our screen for this week and sort by peg ratio. A lot of times you see some good ideas in some of the out of favor, super out of favor stocks. You can see that if we look at our peg ratio of this is like 10 times undervalued. You see a lot of financials in right now. Um, there's a big fear that we're in a private credit um, crisis. So that's leading a lot of the financial stocks to go down. I thought it'd be interesting. Okay, so you can see we do have some sectors, right, stocks right now that are involved with energy and gold and some of the sectors that we're interested in. We see CNX, they actually do natural gas. They're a related company. We have Barrick Mining. They do gold manufacturing and manufacturing, gold mining. Um, okay. I don't see any big companies in this. When I look through all the um, low peg ratio stocks, whenever the stock market is crashing and going down lots, I want to see like really big Microsofts, Googles, and showing up where peg ratio is less than one. It's at that time I want to start dollar costing into them. But right now we still have basically the high tech companies still a little bit overvalued. All right. So here's just another reminder. Um, the big issues that we've had in the past, such as Black Monday, we've had Nixon resigns, we had taper tantrum, Russia invades Ukraine. You can see that they're just a little blip on our chart of a stock market that continues to go up. So this little thing is happening right now with the war. And we have private credit. We have all these things happening right now. But Warren Buffett would tend to say, hold what you have. And um, whenever people are, whenever it's raining gold, you put out buckets and you don't put out a thimble. So we have to wait. So let's go back to this very important chart at the beginning here. Okay, this chart right here. You can see that currently we are in a downtrend in all the moving averages. So the prevailing trend for stock prices are down. We're going to keep an eye on this chart and wait for all the moving averages to start turning up. And when that happens, then whenever the short-term moving averages start before the long term. And whenever we see this kind of come together and start going up together, that's the time when um, that's the time that you want to start dollar costing into some of the positions for the growth part of your portfolio. But right now, um, we just have to relax and um, enjoy the stock market going down. All right. Well, I hope you've enjoyed this talk, and I hope you have a very good investing week. And I'll talk to you next time.